Well, the minutes of the latest Fed meeting show that officials agreed that another rate hike of 50 to 75 basis points would likely be appropriate at its meeting later this month. Officials also acknowledge that there could be an even more restrictive stance that could be appropriate if inflation remains high. Now, the minutes show that Fed officials were worried about inflation becoming entrenched. That was debated several times in this document. Many participants viewed that as a significant risk. Now, officials believe that the Fed's credibility had helped shift market expectations toward a tighter policy stance, and they viewed raising rates as required to meeting the central bank's legislative mandate. Now, Fed officials also repeatedly highlighted the disparate impact that inflation is having on low and moderate income households. Officials also noted there could be some clouds on the horizon as well. Some pointed out that the pressure for additional wage increases appears to be receding. There were anecdotal reports as well of consumer sales starting to slow and businesses delaying investments because of rising costs. Now, officials said that low and moderate income households are spending more of their budgets on food, energy, housing, all sectors that have been strongly impacted by those rising prices. But they also stressed that persistently high inflation could stand in the way of achieving their maximum employment mandate. Still, the committee did acknowledge that higher rates could result in slower economic growth and dampen the labor market. That is why the Fed removed language in the statement that indicated the Fed could both return inflation to 2% and deliver a strong job market. So, guys, that's just a sign that Fed officials are acknowledging and understanding that that soft landing could be very difficult to pull off. Back over to you.